America is being told the job market is strong, but beneath the headlines, it is quietly breaking. More than 1 million jobs were erased through revisions, not layoffs, revisions. Young workers now face the worst unemployment conditions in nearly 4 decades, with applications overwhelming job openings by 400%. Over 7.4 million Americans are officially looking for work, while millions more are working multiple jobs just to survive. Meanwhile, the stock market celebrates because rising unemployment brings rate cuts, cheaper debt, and higher asset prices. This isn't a weak job market. It's a system designed to profit when workers lose. The American job market does not collapse suddenly. It collapses quietly behind numbers that look reassuring but are structurally misleading. What the public sees is a single headline unemployment rate hovering around 4%. What they don't see is how aggressively that number is engineered to appear stable while underlying conditions deteriorate. First, the headline unemployment rate only counts people actively looking for work in the last 4 weeks. Anyone who gives up, pauses, or accepts unstable gig work simply disappears from the data. That exclusion alone removes millions of working-age Americans from the official picture. Labor force participation remains well below pre-pandemic levels, yet this gap is rarely framed as a warning sign. A smaller workforce mathematically lowers unemployment, even when job quality collapses. Then come job revisions. Over the past year, initial employment reports overstated job creation by more than 1 million positions. These weren't layoffs. These jobs never existed. They were quietly erased months later, after markets reacted, elections passed, and narratives were cemented. Revisions happen every year, but the scale matters. When revisions consistently move in one direction, they signal systemic distortion, not statistical noise. Multiple job counting further inflates the illusion. One person holding 2 or 3 jobs is counted as multiple jobs created, even if their total income hasn't improved. This allows rising employment figures to coexist with stagnant wages and rising financial stress. The data celebrates job quantity while ignoring job sustainability. Wage statistics suffer similar manipulation. Average wage growth is often boosted by high earners, masking stagnation at the bottom and middle. Median wages, which better reflect reality, lag far behind inflation. Since 2020, cumulative inflation has exceeded 20%, while real wage growth for most workers has failed to keep pace. A job that exists on paper but loses purchasing power every year is not economic progress. It is controlled decline. Productivity data tells another uncomfortable truth. U.S. worker productivity has risen sharply over the last decade, yet real compensation has barely moved. The gap between what workers produce and what they are paid continues to widen, funneling gains upward. This is not a failure of effort. It is a structural redistribution embedded in how success is measured. Together, these distortions create a mirage: stable unemployment, rising jobs, growing wages. But underneath, fewer people are participating, more people are juggling unstable work, and purchasing power keeps eroding. This statistical fog is not accidental. It sets the stage for the next layer of the system, one where financial markets, policy decisions, and corporate strategies all benefit when labor conditions worsen, not improve. Once labor data is distorted, incentives quietly flip. In today's U.S. economy, worsening job conditions are no longer a threat to markets. They are a trigger. Wall Street does not react to human outcomes. It reacts to policy signals. And the most powerful signal of all is labor weakness. Rising unemployment suppresses wage pressure. Suppressed wages reduce inflation. Lower inflation gives the Federal Reserve political and technical cover to cut interest rates. Rate cuts lower borrowing costs, inflate asset prices, and reignite leverage. This is the chain reaction markets are waiting for. In the last 2 cycles, rate cuts of just 100 to 200 basis points triggered trillions of dollars in equity gains, even as household finances weakened. This is why markets rally on bad labor news. When job growth slows or revisions turn negative, futures spike. When layoffs rise, bond yields fall. When wage growth cools, equities surge. It is not optimism, it is positioning. Asset markets are structured to benefit from economic softness because softness forces monetary easing. The numbers expose the imbalance. Roughly 90% of US stocks are owned by the top 10% of households. The bottom half of Americans own almost no financial assets, yet they make up the majority of the workforce. That means falling wages and job insecurity, the pain side of the equation for workers, become upside catalysts for asset holders. The system produces winners and losers by design. Corporate behavior follows the same logic. Labor is the largest controllable expense for most firms. Cutting headcount immediately boosts margins. Freezing hiring protects earnings. Replacing full-time roles with contract labor reduces long-term liability. In an environment where Wall Street rewards quarterly results above long-term stability, weakening labor conditions are treated as efficiency, not failure. Even public policy reinforces the cycle. Strong employment raises fears of inflation. Inflation threatens asset valuations. Weak employment justifies intervention. The economy no longer strives for full employment. It manages acceptable instability. As long as consumer spending doesn't collapse outright, pressure on workers is tolerated, sometimes encouraged. Debt completes the loop. Lower rates don't rescue workers, they re-leverage the system. Households already carrying record debt, over $18 trillion in total, are nudged toward more borrowing just to maintain living standards. Asset prices rise faster than wages, widening inequality further. The same workers squeezed by layoffs and wage stagnation are priced out of housing and forced deeper into credit dependence. This is the pivot point. The statistical mirage makes labor weakness look manageable. Market incentives then transform that weakness into a feature. From here forward, the economy does not attempt to protect workers, it optimizes around their decline, setting the stage for structural damage that no rate cut can reverse. The labor market doesn't just fail people at the point of hiring, it fails them over time. What's collapsing now is not employment itself, but the career ladder, the mechanism that once turned work into progress. Entry-level roles have quietly vanished. More than 60% of job postings labeled junior now require 2 to 5 years of experience, creating an experience paradox that blocks new entrants before they begin. Internships, once pathways, are increasingly unpaid or temporary, offering exposure instead of income. Training budgets have been cut across industries, with corporate spending on employee development down roughly 20 to 30% from pre-2020 levels. Companies no longer invest in workers, they shop for finished products. Mid-career stability is eroding even faster. Average job tenure in the US has fallen to about 4.1 years, and for many sectors it is far lower. Internal promotions, once the backbone of upward mobility, are being replaced by external hiring freezes and lateral shuffles. Salary bands compress from both ends, entry pay rises just enough to attract labor, while experienced workers hit ceilings that fail to adjust for inflation. Advancement slows, then stops. The structure of employment itself has changed. Contract, temporary, and project-based work now represents over 30% of the US workforce when gig and contingent labor are included. These roles strip away predictability. No clear raises, no ladders, no long-term planning. A job becomes a task. A career becomes a sequence of resets. Credential inflation compounds the problem. Degrees that once unlocked opportunity are now baseline filters. Licensing requirements expand into roles that never needed them before. Certifications pile up, each costing hundreds or thousands of dollars, shifting risk and expense onto workers while employers maintain flexibility. The price of employability rises while the payoff shrinks. Age becomes a silent barrier. Rehiring timelines lengthen sharply after layoffs, particularly beyond age 45, regardless of experience. Resumes are filtered algorithmically for keywords, recency, and salary history, not competence. Entire decades of expertise are discarded because they don't fit automated templates. Geography tightens the trap. Return-to-office mandates restrict job access to high-cost regions, even as wages fail to match local housing prices. Workers are told to relocate without compensation, absorb higher rents, and accept stagnant pay, all for roles that can disappear in a quarter. This is the downstream consequence of an economy optimized for flexibility over continuity. When markets reward cost-cutting and data disguises decay, careers stop functioning as ladders and become treadmills. And once upward movement is removed, the job market doesn't just stall, It locks people in place, preparing the ground for the next, more aggressive phase of collapse. When career ladders stop functioning, automation doesn't arrive as a disruption. It arrives as confirmation. AI didn't suddenly break the job market. It revealed how fragile it already was. For decades, productivity gains were absorbed quietly by corporations, while wages stagnated. AI simply accelerates that transfer. US firms now deploy automation not to replace labor shortages, but to eliminate labor costs entirely. McKinsey estimates that 30% of US work hours could be automated by the early 2030s, yet hiring pipelines and retraining systems remain largely absent. The problem isn't displacement alone, it's abandonment. AI is being integrated at the task level, not the job level. That distinction matters. When software absorbs 20 to 40% of a role's responsibilities, companies don't redesign jobs upward. They consolidate positions downward. One worker absorbs the output of two. Headcount shrinks without formal layoffs. Productivity rises while payroll contracts. This is how employment erodes without triggering alarms. White-collar work, once considered insulated, is now the primary target. Customer support, marketing, accounting, legal research, and entry-level programming are among the fastest automated functions. These roles historically served as gateways into stable careers. Their removal doesn't just reduce jobs, it collapses pipelines. Without entry points, experience cannot accumulate. Without experience, advancement becomes impossible. Corporate spending patterns confirm the intent. Capital expenditures on AI infrastructure have surged into the hundreds of billions of dollars, while spending on workforce development remains a fraction of that. Training budgets are treated as optional. Automation budgets are treated as essential. This signals priorities clearly: replace first, retrain later, if at all. The speed is deliberate. AI allows companies to test reductions incrementally, avoiding public backlash. Instead of announcing layoffs, firms restructure teams, freeze hiring, and quietly reduce headcount through attrition. Labor force participation drops. Output remains stable. Headlines stay calm. The system appears resilient while opportunity disappears. Wages absorb the shock next. As AI increases labor supply indirectly by reducing demand, wage growth slows further. Workers compete not just with each other, but with software that doesn't negotiate, doesn't unionize, and doesn't cost healthcare. This tilts bargaining power decisively. Even high-skill workers lose leverage when replacement costs approach zero. This is the exposure point. AI works because the job market was already optimized for disposability. Weak ladders, minimal training, and the short tenures created an environment where automation could scale instantly. The technology didn't remove stability. It arrived after stability was already stripped away, revealing an economy that no longer builds workers, only extracts output from them. As automation quietly shrinks real opportunity, the appearance of hiring becomes more important than hiring itself. When jobs disappear, the illusion of jobs must expand. That is how the fake job economy takes hold. Across the United States, a majority of large employers now post openings with no intention of filling them. Internal surveys show that over 60% of companies list roles that are never meant to be hired, not as mistakes, but as strategy. These listings serve multiple functions at once. They collect resumes, test salary expectations, benchmark competitors, and most importantly, discipline existing workers through fear. Fear has become a productivity tool. When employees believe replacements are waiting, output rises without raises. Studies show that workplaces engaging in fake hiring report productivity increases of nearly 75%, even as wages remain flat. The message is silent but clear: you are replaceable, even if the replacement doesn't exist. The deception goes further. Nearly 85% of companies admit to interviewing candidates for roles that are frozen or imaginary. Interviews are used to maintain the image of growth, reassure investors, and signal resilience to markets. A company that looks like it's expanding is treated as healthy, even when headcount is quietly shrinking. Revenue incentives reinforce the behavior. Roughly 70% of firms report that persistent job listings improve financial performance either by suppressing wage demands or improving valuation optics. Hiring activity, real or fake, has become a line item in investor storytelling. Growth is suggested, not delivered. For job seekers, this creates a closed loop of exhaustion. Applications surge, response rates collapse, and rejection becomes the default outcome. The volume of applicants per posting has exploded, often exceeding 300 to 400 applicants for a single role, not because demand is strong, but because supply is chasing shadows. Time, energy, and hope are burned pursuing positions that never existed. The moral barrier has collapsed as well. Surveys show that over 70% of executives now consider fake job postings ethically acceptable in uncertain economic conditions. Workers are no longer treated as participants in the economy, but as variables to be managed. Transparency is sacrificed for control. This environment pairs perfectly with automation. When real hiring slows and fake hiring accelerates, companies maintain leverage without commitment. The labor market appears active while opportunity evaporates. And as the system shifts from real jobs to simulated demand, the final transformation emerges, where even the act of searching for work becomes monetized, and desperation itself turns into a business model. When fake hiring becomes normalized, the job search itself transforms from a pathway into a product. Once opportunity is simulated, desperation becomes monetizable. This is where platforms step in, not to fix the market, but to harvest it. US job platforms no longer function as neutral marketplaces. They operate as toll roads. Visibility, response rates, and networking access are increasingly locked behind subscriptions costing $25 to $50 per month, turning unemployment into a recurring expense. As hiring weakens, platform revenues surge. This is not a coincidence. Platform growth is strongest when job seekers outnumber real openings by the widest margins. Algorithms intensify the imbalance. Applications are filtered, ranked, and buried long before a human sees them. Recruiters receive hundreds of resumes per role, yet candidates are told to optimize keywords, rewrite profiles, and upgrade accounts to stand out. The burden of inefficiency is shifted entirely onto the worker. Time spent searching becomes unpaid labor, feeding engagement metrics. Premium features promise access, direct messages, profile boosts, priority placement, but deliver probability, not opportunity. Even when hiring is frozen, listings remain live and traffic continues flowing. Platforms collect data on salary expectations, regional demand, and skill trends, packaging labor desperation into market intelligence sold back to employers. The financial scale reveals the incentive. Major employment platforms generate billions of dollars annually, with year-over-year growth accelerating during periods of mass layoffs and hiring slowdowns. Job scarcity drives engagement. Engagement drives subscriptions. Subscriptions drive profit. Solving unemployment would undermine the business model. This system also reshapes behavior. Job seekers are pressured to apply faster, wider, and cheaper. Wages are anchored downward as candidates compete in algorithmic funnels where volume beats value. Employers gain leverage without raising pay, while platforms profit from the friction itself. Networking, once organic, is now gated. Human connection is rebranded as a feature. Access to recruiters, hiring managers, and referrals is increasingly sold as an upgrade, creating a two-tier job market: those who can afford visibility and those who remain invisible. The result is a closed ecosystem where failure sustains growth. Fake jobs keep traffic high. Platforms monetize the search. Employers extract data without commitment. Workers cycle endlessly, paying to compete for positions that may never materialize. This completes the transformation. Employment is no longer just unstable, it is intermediated, monetized, and abstracted. And once survival itself becomes a revenue stream, the final pressure point emerges: wages that no longer support life and work that no longer delivers a future. Once the search for work is monetized, the next pressure point tightens automatically. Pay no longer needs to sustain life, only participation. Wages stop being a reward and become a filter, just high enough to keep people working, never high enough to let them escape. On paper, earnings appear to rise. In reality, purchasing power keeps collapsing. Since 2020, cumulative US inflation has exceeded 20%, while median wage growth has lagged far behind. What looks like a raise is often a delayed pay cut. Dollars increase, but what those dollars buy shrinks faster. Housing exposes the break most clearly. The median US home price now hovers near $420,000, while mortgage rates remain elevated. Roughly 79% of Americans cannot afford the median home, even with full-time employment. Rent offers no relief. Average rents are up more than 25% since 2020, consuming a growing share of take-home pay. Work no longer leads to ownership or stability, it leads to permanent extraction. Healthcare deepens the squeeze. Employer-sponsored insurance premiums have risen steadily, while deductibles and out-of-pocket costs quietly transfer risk to workers. A job that once provided security now delivers uncertainty. Coverage exists, affordability does not. One illness can erase years of income gains. Food, energy, and transportation finish the compression. Grocery prices are up roughly 25 to 30% over 4 years. Insurance costs surge alongside vehicle prices. Commutes grow longer as workers are pushed farther from affordable housing. Each category tightens simultaneously, leaving no margin to recover. The minimum wage debate reveals how far reality has drifted. The federal minimum remains $7.25, unchanged for more than a decade. Adjusted for inflation alone, it would exceed $15. Adjusted for productivity, it would approach $21. Nearly half of American workers earn below that level, meaning millions are producing record output while falling behind year after year. This isn't stagnation, it's design. Asset prices inflate faster than wages because capital is protected and labor is flexible. When pay fails to keep up, workers compensate with debt. Household liabilities now exceed $18 trillion, locking people into jobs they can't leave because survival depends on steady cash flow. At this stage, employment still exists, platforms still operate, and jobs still post. But the equation is broken. Work no longer builds security, savings, or mobility. It only maintains access to the next paycheck. And when labor reaches this point where effort cannot translate into progress, the system doesn't just strain. It destabilizes, preparing for its final and most dangerous phase. When wages no longer sustain life, the system reaches its terminal logic. At this stage, the labor market does not correct itself. It hardens. What emerges is not recovery, but a new baseline where instability is permanent and mobility is removed. The endgame is structural. Employment becomes fragmented into short-term roles, rotating contracts, and contingent work that never matures into security. Long-term planning disappears because the system no longer requires it. When firms can scale output through automation, outsource risk through platforms, and suppress pay through oversupply, there is no incentive to rebuild durable employment. Stability becomes inefficient. Economic division accelerates. The top tier accumulates assets inflated by policy and leverage, while the majority remain locked into income that loses value each year. Roughly 70% of US GDP depends on consumer spending, yet that spending is increasingly driven by the top income brackets. The bottom half of households carrying minimal assets and rising debt lose relevance to growth models. When workers are no longer the engine of expansion, their welfare becomes optional. Political systems struggle to respond because the damage is diffuse. No single crash signals failure. Instead, participation erodes quietly. Labor force engagement declines. Job searches extend from weeks to months to years. Underemployment becomes normalized. Official metrics lag reality, and by the time distress registers, the damage is embedded. Social consequences follow predictably. Delayed family formation, declining birth rates, and geographic immobility are not cultural choices. They are economic constraints. When housing, healthcare, and education costs outrun earnings, future planning collapses. A labor market without upward paths produces a population focused on survival, not investment in society. At this point, policy tools lose effectiveness. Rate cuts inflate assets without restoring opportunity. Stimulus boosts consumption temporarily but does not rebuild careers. Training programs struggle because entry points are gone. Even job creation loses meaning when new roles lack durability or purchasing power. The system treats symptoms while the structure decays. The most dangerous shift is psychological. When effort stops producing progress, trust dissolves. Workers disengage not because they are lazy, but because the equation is broken. Productivity gains slow. Innovation concentrates at the top. Resentment replaces optimism. Division deepens, not because people disagree, but because scarcity forces competition downward. History shows that systems rarely collapse from exhaustion alone. They collapse when legitimacy evaporates. A labor market that cannot offer dignity, stability, or a future eventually loses consent. When enough people realize that working harder no longer improves outcomes, participation becomes transactional, minimal, and fragile. This is the point the US is approaching. Not a sudden implosion, but a locked-in decline where opportunity narrows each year and recovery becomes mathematically harder. The system still functions, but only for those positioned above labor. For everyone else, the future is no longer something work can buy. That is the endgame. An economy where jobs exist, effort persists, and growth headlines continue, yet the promise that work leads somewhere is gone. And once that promise breaks, no amount of data, platforms, or technology can rebuild it without fundamentally changing the incentives that destroyed it.